What's going on, guys? It's your boy Henry, and today we're going to be talking about options trading, why you want to trade options, how to trade options, how to pick options, and 5 strategies, specifically 5 beginner strategies that you can kind of get started with if you want to make some money with options. So grab an apple, put your little Mexican hat on, put it on your head, and let's just talk about options trading. All right, so the first thing that you have to know about options is there are contracts on a stock doing something, and if a stock actually goes up or down, you can bet on its activity by using an options contract. And in many case scenarios, options can help you make more money faster, but they can also reduce your risk if you're hedging your position. The thing with options is people think that it's for gamblers, but in fact, options are one of the safest things that you can do to a portfolio if you actually understand what you're doing. So I'm not gonna waste any time. Let's just jump into the option strategies that you can use. And let's start off with number 1, buying call options. So buying call options is essentially betting on a stock going up, except with a call option, rather than having shares of stock, you have a call option on the stock, and every single call option represents 100 shares. So what are the benefits and what are like the downsides of buying call options? Well, for one, the pros. So if you were to go out there and buy 100 shares of a $100 stock, you would have to have $10,000 worth of capital, which is sometimes expensive. With a call option, however, since it represents 100 shares, you can own the same amount of shares and have the same amount of power by paying a fraction of the price, because an option is way cheaper than actually going out there and buying shares, and many times it can be 50 or even 100 times cheaper. So with the example that I just made, a call option might be worth $1 and it will control 100 shares, whereas 100 shares are going to be $10,000. Of course, the $1 that I was just talking about is actually $100, because each contract is worth 100 shares. So with call options, you have a lot of exposure for a lot less money. Therefore, it's a great strategy for people that want to make big bets on a stock that don't have as much capital, or they just want to make a really big bet and leverage their capital so they can make greater returns. All right, so in a nutshell, that is the basics of buying a call option. The only downside is if the stock goes down, if you're a general stockholder, you end up losing some money, but you still have the stock. With a call option, however, let's say you go out a week and you say, hey, this call option I think is going to go up, and you go out a week and it doesn't go up. At the end of the week, you will actually end up losing your entire premium. So in that sense, yes, you can lose money with options, and that is the riskiest strategy of all. So in that scenario, yes, you can lose some money, and a lot of people are like, well, options don't really work because I tried buying some call options and I lost some money. Well, in that scenario, yes, you can lose some money. If you're buying call options, in my opinion, it is one of the riskiest strategies because it's very similar to just going to a casino and basically betting on black. With a call option, you're doing something very similar. You're buying something and you're hoping that it goes up, and oftentimes it might expire and it might be worthless, so you end up losing money. And then you think to yourself, whoa, this is an awful way to make money. Options don't work. I bought some options and it didn't go my way. Well, the thing is, if you actually shift that mentality, and the second strategy that I'm going to talk about is usually a little bit better. It's called covered calls or selling call options. So rather than having the mentality of going out there and buying some call options and hoping, just, oh my goodness, I hope this stock goes up above my strike and I hope that I can make money here. Instead, what you can do is you can sell call options. So let's say we go back to having 100 shares of a stock. Now, if you sell a call option, what you're doing is you're collecting premium, because selling call options means that you take in premium, but now someone else has that call option. And basically, if you sell that call option that is out of the money, let's say you have a stock at $100, you sell that call option at $110. Well, now what you're saying is at $110, I'm ready, or I will have to sell this stock at $110. However, if you think about that scenario, the stock is currently $100. And if you sell a call option at the 110 strike, you're saying, hey, I'm gonna sell this stock at $110. However, if you think about it, 100 to 110, you actually make $10 worth of money right there, plus you get paid for the option. So the tables have completely turned. The tables are now in your favor, and you have sold the call option, so you've collected money and you have potential to still make gains on the stock. However, the downside here is that you are limited. If the stock goes to $300 per share, well, you can only benefit up to $110, but you know, what stock is going from 100 to 300 in like a week or two? So if you understand selling call options, most of the time you can sell a call option that is enough out of the money where you'll be happy to sell the stock at that price. Therefore, selling call options is one of the best strategies that you can use to not only make money, but also have stock appreciation. All right, so the difference between buying call options is like being a casino goer, and then the difference between selling options is being the casino. So if you're gonna pick one of the strategies and you're a beginner, it is highly recommended that you buy 100 shares of your favorite stock. You don't have to buy an expensive stock. You can buy a stock, you can buy something like 100 shares of American Airlines. That's gonna cost you $2,000. And then you can sell a call option at like the 23 or the 24 strike 2 or 3 weeks out. By the way, this information, you can use it at any time in history pretty much. If American Airlines is 15 per share, you buy 100 shares at $15 and you sell an 18 strike. The point is you're buying 100 shares of something and you're selling a call option that is out of the money, that is away from the current price, and it is higher. All right, so now let's talk about the put side of things. If you are a put buyer, you are betting on a stock falling. So instead of shorting shares, instead of going out there and having to short a stock so you can benefit from it falling, instead what you can do is you can buy a put option. A put option benefits when the stock falls in a very similar manner that a call option benefits when a stock rises. With a put option, again, you're buying a contract, you're paying premium, you're picking a strike. A strike is where you're betting that the stock may go and you're hoping that it goes below that strike in the case of a put. If you're buying a call option, you hope that the stock goes above your strike, but with the put option, since you're betting on the stock falling, you want it to go below your strike. So you have a strike, obviously you're paying money for this option. Now you have to pick a date that you want to go out for. And let's say the stock has a catalyst in the next couple of weeks and you think that it might fall. Well, then you would want to go 2 weeks out with the option. Generally, I recommend people do weekly options. However, monthly options are totally fine. And if you want to do longer dated options, it's actually called leaps. Leaps are also very popular. In fact, I should probably make a video on it. If you want to see a video on that, give me a comment below. So with leaps, you're going out something like 6 months or even a year. Those are longer dated options. So if you buy puts, it's basically just a way for you to bet on the stock going down. The fourth strategy is selling puts. Again, going to that casino and being the casino mentality. Selling puts is being the casino. Since you collect premium upfront, you collect some cash. And when you sell a put, the way it actually works is you're basically saying, hey, if the stock falls, I'm prepared to buy it. So when you're buying puts, well, if the stock goes down, you're benefiting from it going down because you can sell it to someone else at a certain price. Here, when you're selling puts, you are the person that might be obligated to take shares at a lower price. But if you actually think about it, you have to take shares at a lower price. So let's say Apple's at $135. If you sell the put at $120, you're saying, I will buy Apple at $120. If you think about it, people always want to buy a stock that is a good price. They're like, what price do I enter into? Well, when you sell a put option, you're basically creating a potential entry price into the stock that you're selling a put on. And then again, when you're selling a put, you're collecting premium, and you can go out a week, 2 weeks, a month, whatever date you choose, you're collecting premium and you're creating yourself an entry price for the stock should you get put by expiration. And a lot of people are always curious, can I get exercised before I don't have the money in my account? Well, the thing with that is getting exercised early almost never happens because people that exercise early just end up wasting the time premium, which is part of the value of the option. So for number one, don't worry about getting exercised. But number two, I'm only recommending that people sell cash secured puts. I do not want anyone going out there and selling naked puts. What that means is when you sell a $100 stock, if you only have 20 bucks in your account, that's no good because you might have to take that stock. You might be forced into buying it. And if you don't have enough money, well, you're now in a pickle. You're in a very bad situation. So what you want to do is you want to sell cash secured puts. So if worst comes to worst, you now own a very good stock that you want to own anyways. And that's really important with selling cash secured puts. You don't want to sell cash secured puts on some garbage out there. You actually want to sell it on a stock that you would not mind owning. So in the worst case scenario, if a stock gets put to you and that stock ends up falling, you get to pick a stock that you wanted to be in anyways, but now you got a very good price for it. All right, and the last thing that I want to talk about, this is a little bit more advanced. It is called spreads. So what spreads are is when you combine two different options. Basically, you have call options, right? But here you buy a call option and you sell a call option and you close off. That's why it's called a spread. So in the case of, buying call option, let's say the first one cost you $1,000. Well, if you sell a call option that is out of the money, more out of the money than the first one, and it might be $500, in this scenario, you spent $1,000 and you got paid $500, you created yourself a spread. You actually subsidized buying call options with selling call options, but you still get to benefit in between them. So for example, what do I mean by that? If you buy a $120 call option, but you sell a $130 call option, you can only benefit between $120 to $130. And now your $120 call option is actually subsidized by your $130 call option. So instead of owning $120, if you think the stock can go past $120, but it can't really go past $130, well, it's a phenomenal idea to go ahead and buy one call option, but sell another call option so you can get premium from one side, but also make money from the other side. This is also true with puts. You can create spreads on puts, and that stuff can get pretty complicated, but I'm interested in making a video if you guys show this video enough love. So again, I kind of shot from the hip here. I just wanted to get a video out and bring more awareness to options because I think options are underutilized and a lot of people are just general stock investors, but I think a lot of people can make more money and can improve their money-making toolkit if they understand a little bit more about options. If you're interested in learning about options and you want more structured videos, I have a full playlist right here where I actually talk about buying call options, selling call options, buying put options, and selling put options in much greater detail. Thanks for watching, and I'll see you guys soon.